Is there anywhere in the municipal bond market that might be a safe haven and a time where we don't have that many of them, Jennifer?
Yeah, well, we actually believe that all parts of the municipal market can be a great place to invest. If you're looking to maximize yields, of course, you want to go out the maturity curve and down the rating scale. But one of the things that we love about the municipal market is that we're able to meet the needs of our clients. We have portfolios and different strategies: short, medium, long term, high grade. We have high yield. We actually think there's value at all aspects of the maturity curve and all of that sort of thing. And we have an experienced research staff to help us really find those opportunities anywhere.
What happens to states with large agriculture-based economies or trade-based economies, or perhaps those with ports?
Yes, so the impact of the tariffs will directly impact certain states and certain regions more than others. And you nailed it exactly where we're kind of focusing our attention. It's those states that have the big agricultural areas that are very dependent on trade, and also those mainly coastal communities where they have large ports and logistic operations that normally handle the incoming and outgoing trade. And one of the things that we feel comfortable with, however, is that generally Muni credit is very resilient. And if we look at the port credits as an example, many of them are diversified, meaning they have many streams of revenue, some of which will be less impacted by the tariffs. So ultimately, we think Muni credit will be able to react well to some of the challenges that are going to be largely economically driven from these tariffs.
Jennifer, we've seen the administration pull a lot of funding from higher education, and we've also seen massive DOGE cuts so far. How are those actions affecting municipal bonds in those sectors?
Yeah, so you've hit on a couple of the sectors that we're watching closely. I'll take the DOGE cuts first in terms of employment, and I'll take the DC metro area as an example. And we're definitely going to see layoffs there. And, the DC itself, Northern Virginia, Maryland will be impacted. However, one of the things that we like to point out is, I'll take Virginia first. Virginia is a large state. The, DC area is a small portion of it. We're not really expecting any large impacts to credit on the Virginia credit. Largely the same thing in Maryland. DC is a little different. They were actually struggling and were already on negative outlook prior to the announcement of these costs. And what we're watching there is what happens to these people who've been unemployed. Can they find jobs elsewhere? Do they end up relocating? What happens to the housing market? And then related to some of the desires to reduce the amount of real estate that the federal government leases or owns, what's the impact going to be on the commercial real estate area in DC? To your question on private higher education and also healthcare in the same way, we're watching closely to see what happens with federal grants, whether it's research driven or Medicaid driven in terms of healthcare. We're watching to see what happens. On the private higher ed side, we actually find the market to be largely bifurcated when it comes to credit, meaning that you have a really strong portion of the private higher ed market. Think, credits like Harvard and Stanford and Yale and, the big flagship public universities. And then you have those small regional colleges, and those have been struggling for the past few years. We think a lot of these federal cuts are more likely to impact those stronger credits within the sector. So we feel pretty good, continue to feel pretty good